G'day everybody, Max right here, and here with one of our favorite guests here at the channel with Dr. Jeff Ross. Jeff, thanks so much for being with us.
Thanks for having me, Max. I always love being on your show.
Okay, so we're a couple of days past the Fed announcement. Why don't you catch everyone up, just for those who didn't see it, what happened? We'll start with there, and I've got a couple of follow-on questions after that.
Sure. So for anybody who hasn't been paying attention, it was kind of more of the same. He in essence said we're going to keep the Fed funds rate higher for longer because inflation is still being sticky, and what that did is it reset market expectations in a negative way. So we saw the stocks kind of crumble after the FOMC meetings were released and after he spoke, and then even into yesterday, Thursday, the 21st, they went down again. They're having a little bit of a rebound today, but what it did is it reset expectations that they truly are going to be hawkish for longer. They're going to keep rates higher for longer. Inflation is going to be sticking around for longer. It's what the market doesn't want to hear, right? And basically everybody's unhappy. The bears are unhappy. The bulls are unhappy. I like to call myself Dr. Crab because of this crab sideways choppy market movement, and I think we're just going to continue to see that. I think because inflation is, I think we're done with the disinflation phase where it went from the CPI went from about 9% to 3%. That was great, but that's over with now. And now we have the problem is what do we do now, and what can the Fed actually do now? And they continue to be hawkish, and the economy continues to be sort of annoyingly strong, right? Manufacturing has been in contraction or a recession, as we'd say, for about 11 months now, and new orders, as far as manufacturing is concerned, has been in the same spot for over a year. The services side of the U.S. economy, though, which is about 70 to 80% of the U.S. economy, continues to barely hang on in expansionary mode. And because it's such a large part of the U.S. economy, that's what's keeping us from rolling over into a recession, like Germany is, like lots of Europe is, like China is. We're not following suit because our services industry is still kind of hanging on a little bit.
Okay, good to know. So the pause is still there, but they basically signal that there's no expectation to raise interest rates in the future. Is that correct?
They discussed that they may still raise. In fact, that there's still a majority of FOMC members that think they need to raise one more time before the end of the year. It's interesting because the betting markets don't think they will, though. So who knows? Basically, they say we'll probably raise one more 25 bips hike. The market disagrees. We'll see who wins. I don't think it really matters in the end.
Okay, gotcha. So we find ourselves in this environment, and as we talked about a number of times, we kind of predicted this sideways year for Bitcoin. But I see some other things going on, and that's still my expectation. It sounds like it's still your expectation. But do you think in the broader markets, and even do you think we will get a recession at some point? And if so, how do you think that's going to affect the different markets? So yes, let's touch on Bitcoin, but let's also touch on the other markets and how it's going to affect those areas if you think it's going to happen.
Sure. So it's always, and I know you know this, Max, but so it's always important to distinguish the difference between the economy and markets, right? People tend to think of those two as the same thing, but they're not. They are sort of intertwined, but they're also separate from each other. So as far as the economy itself, the signs are still pointing towards yes, we probably will have a recession of some sort. I don't spend a lot of time focused on that, mainly because I'm concerned for my clients how to profit in whatever economic circumstance we find ourselves in, right? So whether or not we're in a recession, I'm still going to look for what asset classes outperform. But the yield curve is still massively inverted. It's sort of to the dismay of almost everybody, especially bond lovers. We're having what's called a bear steepener. So the curve is starting to steepen again, or uninvert. It's been inverted for a very long time now, starting to uninvert, but it's doing so at much higher interest rate levels. So basically, if people, for a lot of bondholders who are in TLT or one of those ETFs, kind of on the long end of the bond spectrum, they've been waiting for yields to fall and prices to rise, and they've been wrong and wrong again and wrong again. And I still think they're going to continue to be wrong because this bear steepener means that it's uninverting, but it's doing so at a much higher rate than it was, so much higher yields than it had in the past.
Rather than the short-term interest rates coming down, the long-term interest rates are coming up.
Yes, and they continue to keep going up. And for people who cares about that, most people don't, but that matters a lot for regular people who want to buy a house. If you want to buy a 30-year fixed rate mortgage, it's entirely based on what the underlying 30-year treasuries are doing. So as those yields continue to rise, 30-year mortgage rates continue to rise. So if people are sitting out there and they've been waiting already for about a year for better mortgage rates, and they've been getting slapped in the face, they're going to, I think, continue to get slapped in the face. And I think 30-year mortgage rates are going above 8%. And I don't think they're going to come down anytime soon. So if you're waiting to buy, I just genuinely feel bad for those people, because there's lots of people like me, right? I'm a Gen Xer. I'm older. I locked in a mortgage rate like about 3%, a little less than 3%, and a person like me has almost no incentive to sell a house because the last thing a person like me wants to do, unless I was forced to do it, the last thing I would want to do is get out of a 3% mortgage and get into an 8% mortgage, because you would get much less of a house for about the same price per month. So it's very tough out there.
Very, very tough. So that raises some interesting questions, and I'm fascinated by that real estate market, because it's a huge portion of the U.S. economy as well. Between all of the mortgage brokers and the lawyers and the people all of the satellite industries around that. I read somewhere that in 2022, the commissions paid to real estate agents went down by half compared to the year of 2021. And it was interesting because we didn't see real estate prices come down that much, but the transactional volume became much lower, precisely because there are so few sellers, but also there's so few buyers. Buyers are like, I can't afford houses with these interest rates, but sellers are like, I can't afford to sell. If I've had more children, I want to have more bedrooms, I want to grow my house. I would, under normal circumstances, I'd sell this house and upgrade. I can't afford to do that because I'm tearing up a 3% mortgage and having to go and get a near 8% mortgage. So we're stuck in this house forever. So transactional volumes are way down. Now, in that kind of environment, I think it doesn't take much to reset the prices, to move the prices a lot, because the transactional volume is so low. And so then that raises the question, well, there's always some selling. There's divorces, there's people die, there's widowing situations, there's businesses go bankrupt, there's unemployment, and people do have to sell. So I see that there's this sideways concept is okay, but these things are going to happen where people are going to have to start selling and liquidating either their houses or their other things, and that at some point that process is going to speed up, and then you're going to get a reset of prices. Now, this is probably outside of your realm of expertise, talking about the real estate market, or maybe it's within, I don't know, you tell me. But what are your thoughts on that? I see that as a huge problem for the economy.
Absolutely, Max. I'm with you. And in fact, I just read an interesting stat just today that said and I might get these numbers slightly off, but somewhere in the mid 80% of people who have recently bought a new house at these higher interest rates, they plan on refinancing at lower rates in the near future. That's their plan. So what they're saying is, we can't afford this house. This mortgage is too expensive for us, but hopefully rates will go down in the not too distant future, and then we'll just refinance like everybody used to do in the past. That's not going to happen. And so there are people, and I think as many as 16 to 18% of people cannot afford their payments already, who just bought houses. And so I feel so terrible for these people, because these people are going to be forced out of their houses. They're going to be forced to sell at lower prices. They're going to take a huge financial hit because they just don't have the cash flow to pay their mortgage. We're just at the early stages of this problem, and I think, as you say, the housing market, the real estate market, is a huge part of the American economy. We haven't even talked about commercial real estate, but this is just residential real estate, and these problems are just, I think, going to get worse and worse. So. Yeah, I hate to see it. You hate to see your fellow Americans. And then one little side note, I do know lots of real estate agents. That was kind of the popular thing to do over the last, actually, about 15 years, and more so in the last 5 years again, is to quit your whatever career you had and become a real estate agent. Lots of these people are losing their jobs. They don't have enough work. As you said, the transactional volume is down so far that they can't support their families. They're out looking for work right now. So again, I think we're just at the tip of the iceberg right here.
I agree. So that always, I try and strategize about how to play that. I think we just touched on, we touched on residential, we touched on commercial. There's a whole bunch of other things we could touch on. There's a whole bunch of other ways pins that could prick this bubble. So I'm of the opinion that at some point something will break, and it may be timing. It's always hard, but it could be 2 days, it could be 2 years. I don't know. But at some point, there's going to be this cascade of selling pressure in real estate and other parts of the economy, which will lead to unemployment, which will lead to that recessionary forces. So then the big question becomes, how does one play that? Is it's almost, it's especially in the really forward-looking markets, which I would put Bitcoin in that category. In those markets, it's almost like bad news is good news. It's almost like, oh well, as soon as something like that happens, there'll be some kind of a shock. There'll be some kind of a reflection in that in terms of maybe the Bitcoin price goes down and other markets go down. But then there's almost a very quick recovery whereby it's like, okay, the Fed's going to have to respond to this. The Fed's going to have to lower interest rates, which puts us back in an environment where those forward-looking things like Bitcoin take off and kind of moonshot. Is that your kind of mentality as well, or is it a little bit different? And which kind of markets do you think are going to lead us out of that?
Great question. Very complicated. So I don't think that the Fed will respond with any sort of easing until they're forced to respond. And I think that this process can last a lot longer than most people anticipate. I know a lot of people who, even, me last year, fourth quarter of 2022, I thought we were right at the precipice of a recession. But then all of this fiscal stimulus came along, unemployment remained low. The economy just kind of kept chugging along. That was surprising to me. And I do think, so I could be wrong. Obviously, I was wrong, 9 months ago about it, but that I thought things were going to get worse. This time around, I think that it's very possible that we just continue to chug along and muddle along at this sort of unfortunate state for months and months and quarters, and it could be very frustrating for lots of people. And just sort of one by one, we watch things go down. So how do you play it? Right now, the way I've been playing, and this is sort of counterintuitive, home builders have been crushing it. Normally, they're very sensitive to interest rate changes, meaning that if interest rates are rising as they have been, they normally go down, because what that means is that 30-year mortgage rates are rising, so people just aren't buying houses. And that's true, but because of what we talked about earlier, that frozen buyer-seller market right now, the home builders have stepped into where there's this real paucity of houses, and they've been building like crazy, and they're actually crushing it right now. So yes, they're sensitive to interest rates, but they've been doing so well as a business in general, building these houses while nobody is putting their current houses on the market. So that's been an interesting way to play it. Other ways, I'm not overly optimistic about, I love Bitcoin. We both love Bitcoin. I'm not overly optimistic right now because more than all of these kind of things going on, I think Bitcoin is extremely sensitive to global M2 and liquidity as well. But global M2 is kind of the more direct correlation. So basically what that means is if banks are, they're in business, they're offering loans, they're creating new money, new monetary supply. And that's part of what the money supply is. You can also talk about treasuries, you can talk about money markets and things like that. But as long as M2 is expanding, that's good for Bitcoin. And if it's contracting, that generally is bad for Bitcoin. Global M2, at least among the major nations, has been literally declining. It's at a lower level now, or about equal to where it was at its lows, I believe, in late September 2022. That's kind of when everything sort of bottomed and started to pick back up again. We had this nice little increase for several months. That's when everybody got all excited. That's where Bitcoin ripped much higher. Since then, it's been back down. It's been sliding lower again. So why do I say that? It's because I hear a lot of people talking about Bitcoin hitting all, new all-time highs before the halving, which is coming up, should be end of April of 2024. I don't know where they're getting their optimism. I love Bitcoin. I'm wildly optimistic in the long run, but in the near term, I don't see anything supporting higher Bitcoin prices. So I kind of think at best it goes sideways. At worst, it starts going lower again. If the central banks continue their hawkish stance, and especially Powell, if he continues to refuse, to support the markets in any way and continues to slam on the brakes in his fight against inflation, I think lower risk asset prices and lower Bitcoin are kind of in the future for us, in the near future.
Yeah, I agree with that, and I think that but my view of how it will be is it will be pretty short-lived. I think there'll be we might grind lower. You're right. As you say, things might grind lower, but at some point there'll be a bigger event. This might be reflected in Bitcoin prices in all markets. I don't know, and I think at that stage, then tools and asset classes like Bitcoin that normally respond very, very quickly, then they will see that they will start taking off against, like, okay, the Fed's going to be forced to pivot, and then we'll see a change. But I'm expecting that down before I get that up. Now, I hope that's true because I'm sitting cash heavy right now, and I would hate to miss out on the next Bitcoin boom, but I think we're going to get better prices here soon. So that's where it stands now. I'm going to take a little side note here because all this conversation has just reminded me of something that I can help our viewers out with significantly. What's happening, there's a big shift right now that's happening in the real estate market. Very often, so for 20, 30, 40, 50 years, when you sell a house, what happens is you tear up your mortgage, and then the buyer comes along and they go and get a new mortgage. And that was all so-and-so. Like when you tore up your 5% mortgage and the next person got their 5% mortgage, that was just, par for the course, and there was no benefit to doing it any other way. But there is another way to do it, and it's becoming very, very popular now, but still not many people know about it, which is to take over someone's mortgage. So when you sell your house, you sell your mortgage attached to it. And so you can sell your house to somebody at a 3% interest rate instead of making them go and getting a mortgage, if that's what your interest rate is, and then selling it and then making them go and get a mortgage for 8%. That allows them to pay you a much, much higher price. So if anybody at home is like maybe they're in one of those situations where they would love to sell their house, they need to sell their house, and they want to learn more about this concept, do me a favor, reach out to support at Success Council, and you can just go to the website and fill out the form there, and go there and fill out the form. Ask to speak to me specifically. I will go ahead and coach you through that because it is a real game changer. I'm noticing that. I've done a handful of real estate deals right now, but I only do it where I can use the mortgage of the person behind me because I'm not buying the property at 8%. But if I can use your mortgage at 3%, I can probably buy it way higher than anybody else is asking you. So that's a little tip for the viewers there. Go ahead and do that. All right, Jeff, thank you so much, mate. It's a little bit frustrating. Just before we got on air, you're like, man, I'm almost getting sick of hearing myself talking about it. We're just this crabbing sideways situation. We find ourselves in that situation. You're suggesting it might go on for a little bit longer, but it will end at some point, and that's when I think all this preparation, all this education, all this thing that we're providing people is really going to come into the value is going to be proven. It's going to be very exciting for people. So hopefully we can speak to you again in the near future, Jeff. Is that fair enough?
Absolutely. I look forward to it, Max.
Wonderful. Everyone at home, thank you so much. Go ahead, subscribe, hit the like button. Let me know in the comments just how much you love Jeff being on the thing. That helps me get him back here when I can show him some of those comments. And we'll see you guys soon. Take care.